I've put together what I think could be the cheapest and maybe even the best ETF portfolio that investors can make today. And rather than just list out what you need, I thought it would also be really helpful if I explain how I've made it step by step, so that if you want to use this as a starting point, you can take it and then tweak it to invest just how you like. So first up, let me explain what I'm trying to make and why I'm doing things this way. Firstly, I want to make a nice global investing portfolio, and this means I want to be invested in all kinds of companies from all over the world. This is extremely important, and this is one of the keys to successful long-term investing. You don't want to rely on one company, one industry, or one single country, as anything can happen. So it's valuable to make sure that you stay well diversified. Now for me, this means investing globally, but there are plenty of other people out there who will disagree with that or suggest that all you might need is the S&P 500. In fact, I did a video on that topic not long ago, so feel free to go and watch that one after this. Now secondly, I'm using ETFs as they allow you to invest in lots of different companies through one single investment. And if you pick the right ones, they can also be one of the lowest cost ways to invest as well. Finally, we'll go without saying that I'm going to build this portfolio to be passive. So any ETF that I use, I just want it to follow some kind of index that will end up adding up to the whole world. Right, so the first step I need to do is figure out what the world looks like in terms of the global stock market. Once I figure that part out, I can then break it down and look for ETFs that slot together like a bit of a jigsaw puzzle. Now, there's a few ways you can do this, but for me, I like to use kind of a major index company like FTSE. Now, if I grab their latest data for their global all-cap index, here's what the world looks like from a stock market perspective. In descending order, they break it down like this: North America, Europe, Pacific, and emerging markets. And next to them, as you can see, is how much of the global stock market is inside each region. It's no surprise that North America has the biggest percentage, and inside of that, the United States is really where all the money is at. Canada is included as well, but in comparison, it makes up just a tiny slice of the market. Now, in order for me to make an ETF portfolio that reflects this, I'm going to need to find ETFs that focus on all of these different parts of the world and then put them together. By the way, if you don't want to do any of this process, then there are plenty of ETFs out there already that allow you to just buy the whole world in one go. The only real benefit to doing things like this is that you can get a bit more of control and save on fees. Oh, and if you're a nerd like me, you get to have some fun out of it too. Right, so let's start with the top. We need an ETF that covers North America. Now, believe it or not, there aren't actually that many to choose from for us UK investors. You've really only got a couple here. There's a Vanguard one and an iShares one, and they either use the FTSE index or the MSCI index. There are two versions of the Vanguard ETF though. Just be aware of that, and one pays a dividend and the other doesn't. It's always worth noting that when you look to invest in ETFs, you should pay attention to whether or not it's a distributing one or an accumulating one. For this portfolio, everything I put together will be accumulating, as for me personally, I think this makes a lot more sense and keep things simple. With distributing funds, the ones that pay dividends, you do have to make sure that you reinvest that money. Now, this can be quite simple and cheap with some of the newer platforms, but some of the legacy platforms can make it a bit more difficult or charge you fees to do that. So we'll stick with accumulation versions, and that leaves one choice here, which is Vanguard's FTSE North American ETF with a ticker symbol of VNRG. This has some really nice low fees of just 0.1%. It's got more than 600 companies inside it, and it will cover both the US and Canada. I would have hoped for some more companies here, to be honest, but this will work for now. By the way, for any of the ETFs that I'm speaking about today, you should be able to find them on most good investing apps. The ones I use personally, like Trading 212 and InvestEngine, do have all of these available, and I'll leave links in the description for you to set up your own accounts. There's sign-up offers available. Please do read all of the terms and conditions as usual. Also, as a bit of an added bonus, I'll share these portfolios as links in the description so that you can take a bit of a deeper look or use them as your own. Please do remember though, I'm not a financial advisor. I never claim to be one, so please do what's right for you. Okay, next up, now that we've done North America, let's do the next biggest market, Europe. There are a few different indexes that cover this market, but I settled for the one which I think does the job with some pretty low fees. The one I went for here is Vanguard's Developed Europe ETF. Also has nice low fees of just 0.1% and covers more than 500 companies. It's worth saying here that you will sometimes see European funds that say excluding UK, and if you go with one of these, you'd need to add in the UK as a separate ETF if you wanted to do this. For this portfolio, I wanted to keep things simple, so I've just gone with one fund, but you can make it as complicated as you like. Right, with that one done, the next biggest market to sort out is the Pacific region. So this includes all of the countries like Japan, South Korea, Australia, and Singapore, etc. Now, when I went to choose a fund to cover this area, I quickly saw that almost every fund out there doesn't include Japan. So to counter this and make sure that we include Japan, I also had to find a Japan ETF for us to put into this portfolio. So with a bit of a look around, here's what I ended up doing. I've settled on 2 ETFs. This first one is the Vanguard FTSE Developed Asia, excluding Japan. Now it's got a fee of 0.15% and includes almost 400 different companies. And then to round things off, I actually decided on this iShares fund for Japan. Shock horror, a non-Vanguard fund for once. This is a nice low fee of 0.12% and includes more than 200 companies inside of it. Right, just one final fund to sort out and then we can finally start to get this thing finalized. So keen-eyed viewers will know that we are now left with just one part of the world to sort out, and that is the emerging markets. Huge parts of the world with enormous populations with potential for growth. Now I settled on another iShares fund here, as this was slightly more cost-effective than some of the other options. And here's the one I went for, the core MSCI Emerging Markets ETF. It does have the highest fees of the bunch here at 0.18%, but as you'll see in a moment, because fees are weighted, this only has a very small effect on the overall fees in the portfolio. Worth noting here that some of you may see MSCI and FTSE and realise that we are potentially mixing up 2 index providers. Yes, this is true. They are slightly different in how they categorise the world, and you can read up on this if you want. Ultimately though, the benefit of having these separate ETFs is that you can weigh them out how you like, and that's exactly what we're going to do in the next step. So in order to do this next part, I need to grab the weighting from the first part of the video and then use that as a useful guide to decide how much of our portfolio we want to have in each ETF. Here's where I think one of the big benefits come in for doing it this way if you really want to. You can slightly change the weights depending on where you think you'll make the most money. I ended up settling on these weights, which I'll show you on screen now. Now they match very closely to the weights of the global fund, and this is personally how I'd have it set up if this was for my own investments. As a quick summary, you can see that this portfolio contains 9 different sectors with all kinds of companies inside of it, and you'll see that in total, you'd have a share in more than 3,600 companies. Now, here's the big question. With all of these added up like this, how much are your annual fees going to be? The answer, as you can see on screen here, is just 0.11%. So this means that for every £10,000 you had invested in a portfolio like this, you'd be paying just £11 a year. As always, other fees apply when you invest. It would all depend on the platform you use, but this is very cheap indeed on just the investment side itself. Just as a comparison, paying 0.11% is half of the cost of the equivalent single global fund that Vanguard offer. If you have a look here at a really popular fund, VWRL or VWRP, the fees here are 0.22%. Now, across a single year with £10,000 invested, paying £11 more doesn't sound much, but fees add up and compound over the years because it's not about the fee itself, but the missed future growth. For example, paying 0.11% more per year over 20 years with an investment of £300 a month would mean that you'd end up costing yourself around £3,000 in fees more than the other person. And £3,000 divided up between 20 years worth of months is just over £12 a month in fees. So you can save some money investing. That's almost like getting Amazon Prime and a coffee free each month. Now, I could call it a day and say this is the end of the video, but then I thought, what if we tweak this a bit and bend the rules slightly to make this even cheaper? Now, the biggest cost here is coming from the biggest weight in the portfolio, which is right now this North American fund. But as we saw earlier, it's only got 600 companies inside of it, and in my view, that's not really giving me much more diversification than something like an S&P 500 fund might do. So then I thought, well, what if we replace this fund with an S&P 500 index fund instead? The benefit we'd get here then is pretty much the same number of companies, but we could reduce our costs massively because there's a lot more funds to choose from. After a bit of looking around, I settled on this one here, the SPDR S&P 500 ETF with the ticker symbol of SPXL. It has an insanely low fee of just 0.03% a year. And if I replace the North American fund with this one, here's what the portfolio will now look like. Your total fee now becomes just 0.06% a year. Again, for some perspective, that's almost 4 times cheaper than an equivalent global index fund from Vanguard. So what's the catch? Well, it depends really on you. You see, if you want to build a portfolio like this, then you will have to do a little bit more work. You'll probably want to rebalance it once or twice a year and just make sure that those weights are still in line with what you want. And you will always have a little voice in your head that will tell you to tweak things all the time. Also, we have no idea if something like this, even though it's slightly cheaper, will actually end up beating a single global index fund with higher costs. You just never know really, so there's always a risk that you end up wasting your time, but hey, at least you had a bit of fun and you learned a lot about investing along the way. I did do a video a while back also looking at another kind of portfolio using just 2 funds, and I still think something like this could be a great option too. It's simpler to use than something like this, and it just splits the world up into 2 parts. You've got developed and emerging. At the end of the day though, this one all really comes back down to you and what you need. It's amazing just how much choice we have nowadays, and you can easily make things a lot more complicated than you need to. I'd always say that you're far better off spending more time and effort making money in your day job and getting that into the stock market over the long run than trying to tweak something to make it perfect. After all, I'm not sure that really exists. Anyway, for me personally, I'm now getting a little bit of FOMO as my own portfolio doesn't look as good as this one and actually costs a little bit more. I guess that's another negative point too then. Now, as I said earlier, I've shared these portfolios below for you, at least the ones I've made on InvestEngine, but you can also make them on other platforms like Trading212 as well. You just search using the ticker symbols, you can easily find them, and then you'd add them to a pie, create your own weightings, and make it exactly how you like. If you reckon this portfolio could even be improved better, let me know in the comments section, as I'm sure there are some ways to be more creative and you can build it and make it even cheaper and even better. Anyway, I'll see you in the next video. As always, happy investing.